All right, let's get right to it. The closing print for December 23rd.
Let's do it.
We saw the major U.S. equity indices stage. A spectacular high conviction rebound right into the bell.
Yeah, it completely overrode what was, frankly, a really choppy and lackluster morning,
Totally. The S&P 500, the SPX, finished up a solid 0.45%.
printing its final tape at 6909.48.
And the Dow Industrials managed to squeak out a gain of 0.07%.
Right, but the real story, like you said, wasn't just the numbers. It was that deliberate late-day push.
It's what's so fascinating, right? How quickly the consensus just flipped.
It really is. I mean, the morning looked like typical holiday positioning.
Yeah, traders just squaring up books, really light volume, sort of a drift lower.
Exactly. But the second that key economic data hit, the market went from, total indecision to just high conviction demand.
So that's the story. Let's talk about the catalyst that pushed us over 6,900.
It really came down to one number.
The Q3 GDP data.
It did. That number came in significantly better than anyone expected. It showed the U.S. economy grew at an impressive 4.3% annualized rate.
And that's what flipped the script.
That instantly provided the fundamental justification for all that high beta risk we saw getting poured into the close.
So 4.3% growth isn't just a number, it fundamentally shifts the narrative, especially for the Fed, right?
Absolutely. Consensus was what? Somewhere around 3.8 to 4.0%?
Right.
So 4.3% is meaningful upside momentum. It pushes back hard against those recessionary fears that were creeping back in.
And when you look inside,
Now, you see strong consumer spending, sure, but more importantly, a real uptick in fixed business investment. That's CapEx, not just inventory game.
So it confirms a sticky landing, not a crash landing.
It does. And it puts immediate pressure on the idea that the Fed has to rush in with aggressive rate cuts in Q1.
Okay, so if the economy is this robust, the trade becomes kind of obvious. You rotate out of slow growth or low rate plays.
And you pile into anything that benefits from accelerating economic activity.
Exactly. And we saw that happen in real time with sector leadership.
The shift was immediate. Capital flowed heavily into the growth engines. You had Megacap Tech, communication services, and the energy sectors just leading the charge late in the day.
And you can see that rotation confirmed by what got left behind. Real estate and consumer staples were the worst performers.
They were. And that divergence is just a classic signal. Real estate is super rate sensitive. Staples are defensive.
So when investors sell those,
It's a clear sign they're willing to take on more risk elsewhere. It shows conviction in that economic continuation trade. If they were worried, they'd be buying those names, not selling them.
we even saw a perfect example of that whipsaw action earlier today. I remember looking up and seeing utilities leading the pack.
That's the perfect historical context for the day. Utilities were up, what, 0.85% for a bit in the morning?
Yeah.
That was the defensive posture. That was the flight to safety from the holiday chop. But that strong GDP number just acted like a magnet, pulling capital right back out of safety and into high beta growth.
The speed of that rotation is the tell.
It shows how ready institutions were to pounce on good news, even in thin trading.
All right, let's talk confirmation. Because a late day reversal on low volume is, often just a bull trap. We need to know if the big money was in on this.
The tape speaks volumes, literally.
So what did the volume tell us?
On the S&P 500, volume clocked in at 1.2 billion shares.
And how does that compare?
Crucially, that's a notable 20% jump above the 30-day average.
20%. Okay, so 20% above average on a strong up move. That is significant confirmation.
It is. This was not some tentative rally or a short squeeze. This implies real accumulation.
It suggests the pros were stepping up to absorb supply.
Exactly. That demand absorption gives the 6,900 breakout real credibility. If this had been on average volume, we could just dismiss it.
No, we do have to mention the Nasdaq composite. The volume there was a little lighter than usual, right?
It was about 1.35 billion shares, which is pretty consistent with the holiday week.
So there's some necessary nuance there.
Right. But the key takeaway is that where it mattered, in the SPX and those core mega-cap names, the volume was heavily skewed to the buy side. We saw virtually no heavy selling pressure.
So the institutional footprint is clear. They were buying the close.
Finishing strong near the daily highs on elevated volume. That's the behavior we look for.
What does that mean for follow-through potential?
It suggests professional optimism, or at the very least, a lack of selling conviction heading into tomorrow. The path of least resistance, based purely on this close, remains higher.
But here's where we have to turn the lights on, because despite that strong headline, The internals are, well, they're flashing red.
Deep red.
We had this high conviction push, but what's the underlying health of this rally?
You're hitting on the core vulnerability. The divergence warning is just unavoidable here.
Today's rally was narrow, dangerously so.
It was. I mean, if you strip away the performance of just a handful of names, NVIDIA, Amazon, Alphabet, Microsoft, the rest of the market was basically flat or down.
And this is where the advanced decline ratio is so important.
Exactly. So the S&P 500 is flirting with new all-time highs, right?
Right?
But the AD ratio has reportedly just plummeted. It's like watching a giant cruise ship get pulled forward by only 4 powerful tugboats, while most of the smaller boats are actually sinking.
The index looks strong, but the breadth, the participation from the average stock just isn't there.
It's non-existent, and you see it so clearly in the small caps.
The Russell 2000 lagged significantly. It was down about 0.6%.
On a day, the S&P gained nearly 0.5%. That gap is massive.
Especially when small caps should, in theory, love a 4.3% GDP print.
It tells us that strong GDP number isn't translating into belief that the average company can really expand. Institutions are confident in the top tier of the economy, but maybe not the foundation.
And historically, a narrow rally is a fragile rally.
Always. Let's check the fear gauge, the VIX.
It eased back to 15. That sounds pretty comfortable, doesn't it?
It sounds subdued, yeah.
Yeah.
But a VIX in the mid-teens, especially with this thin holiday liquidity, means anxiety can resurface really quickly.
The hedges are still on.
They're still on. Complacency is not total. They're just waiting for the next data point.
Okay, let's pivot to some specific names that showed textbook key reversals today. First up, Oracle, ORCL.
Oracle is a perfect signal of post-run exhaustion. After being up over 3% on Monday, it declined 1.7% today.
A textbook open high, close low pattern.
Exactly. Early enthusiasm from that GDP print was just met with aggressive selling all day. It's profit-taking.
You're likely seeing traders sell winners to free up capital. You've got to watch for more unwinding there.
Now, compare that to the energy sector. Let's use a hypothetical stock B. This name opens weak, drops, looks like it's dead in the water.
And then a dramatic, conviction-driven surge into the close to finish of 1.5%.
That is the perfect buy-the-dip signal from institutions.
Absolutely.
Early fear was just met with overwhelming demand tied to that robust GDP number. This reversal reinforces the rotation story. Money is actively moving into these segments.
And just to reinforce the mixed message, you had a hypothetical tech stock A open strong but then fade hard to close down 1%.
The message is that the tape is never simple. Under the surface, there's massive distribution happening as capital gets repositioned for 2026.
So what does this all mean for tomorrow? The mission is to find the inflection points for a high-conviction day 2 play.
We need to define our line in the sand, and for that we have to look at the options market, the gamma wall.
Can you just quickly explain the mechanics of the gamma wall for our listeners? Why is that strike so critical?
It's all about market maker hedging. The strongest put wall below us is the immediate risk parameter. If we breach that strike,
The dealers who sold those puts are in trouble.
they're forced to sell massive amounts of the underlying stock to re-hedge their books. This forced selling is what can trigger a flash crash. So that level absolutely has to hold for any continuation tomorrow.
Okay, so that level is critical for risk management. What about the probability of a day 2 follow-through?
Historically, strong trend days have about a 58% continuation probability. It might be a bit higher in a catalyst-driven period like this.
But that's conditional. We need to see confirmation at the open.
Right. We need 2 things to happen in the first hour.
What are they?
First, volume needs to step up again. That confirms the institutional presence wasn't just a one-day thing. Second, price has to hold above key short-term moving averages, like the 10-day EMA.
So high volume consolidation above that level is the green light.
That's the confirmation for the breakout.
And for individual stocks, what are the metrics for a day 2 play?
You're looking for stocks that had a clear, significant catalyst on day 1.
Like the GDP influence.
Right. On day 1, those stocks need to have featured 2 to 3 times their relative volume, their RVOL, and they have to have closed strong, near the high for a long or near the low for a short.
And the triggers are simple. Above the prior day's high for a momentum long.
Or below the prior day's low for a breakdown short. We need liquidity, volatility, and confirmation that the institutions aren't done moving their pieces on the board.
So what's the final takeaway? Give us one big thought to mull over.
Look, despite the S&P closing strong, that divergence we talked about, the plummeting AD ratio, the lack of broad participation, that's a huge vulnerability.
It's the weak spot.
It is. So the question for you, the listener, is this. How long can megacap conviction override this underlying market apathy before this narrowness triggers a real systemic correction, maybe leading into early 2026?
A narrow rally is a fragile beast.
Indeed. And keep a sharp eye on consumer spending data tomorrow. That will be the next key fundamental anchor and give us some crucial inflation clues.
A really deep dive into today's tape. We'll catch you on the flip side.